Imagine a growth ETF with a 10-year total return of 301%. Now imagine if you invested $1,000 to start and added $500 each month into this ETF and got a 14% return. In 30 years, you'd have $2.5 million. Well, perhaps it is possible. Allow me to introduce you to SCHG, the Schwab U.S. Large Cap Growth ETF, the newest addition in my portfolio because I felt like it was the perfect pairing for my largest holding, SCHD. Made up of 252 holdings, SCHD is most heavily weighted in the technology sector, which makes up almost 44% of the total ETF. The top 10 holdings of SCHG are Apple, Microsoft, Amazon, Nvidia, Alphabet Inc. Class A, Tesla, Meta, Alphabet Inc. Class C, United Health Group, and Eli Lilly. The fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. It's the fund's policy that under normal circumstances it will invest at least 90% of its net assets, including, for this purpose, any borrowings for investment purposes in these stocks. The fund will notify its shareholders at least 60 days before changing this policy. The fund generally seeks to replicate the index by giving the same weight to a given stock as the index does. In addition, SCHG may also invest up to 10% of its net assets in securities not included in the index, cash or cash equivalents, including money market funds, and may lend its securities to minimize the difference in performance. A couple of months ago, I stumbled on this ETF while I was researching for the perfect two-fund portfolio, which I'll link in the comments below, and that's what led me down the path to SCHG. Now, because SCHD makes up the core of my current portfolio, I wanted to be sure I wasn't being redundant. So, using the ETF Research Center Fund Overlap tool, I learned that there are only 4 companies that overlap between the two ETFs: Broadcom, BlackRock, EOG Industries, and Coterra Energy. So with that, by adding SCHG, I've created some pretty strong diversity in my portfolio and the growth opportunity that I think I've been missing. Let's look a little further into the performance of SCHG. Starting back in December 2009, we've got 14 years of share price performance. In the last year, they're up in share price by 43%. In the last 5, by 134%. Last 10 years, they're up 266, almost 267%. And if we zoom out even further and look at the max of the 14 years since this fund has been in existence, we see a share price return of 540.78%. Now, anytime we invest in ETFs, we need to consider the costs associated with our purchase, which come in the form of expense ratios. And thankfully, in the case of SCHG, it's pretty low at only 0.04%. This means for every $10,000 invested, you'll pay $4 each year to own SCHG, which is a small price to pay, giving you exposure to 252 different holdings. If we utilize the grading system proprietary to Seeking Alpha, you'll see positive grades for momentum, expenses, risk, and liquidity, but they're giving SCHG a C grade for dividends. Now, because this is a growth ETF, we don't expect to see much in the way of dividends because we're not buying this ETF for the dividends. We're here for the overall growth and capital appreciation. But nevertheless, there is a small dividend, and this was actually just recently paid out earlier in December in the amount of 10 cents a share. SCHD pays shareholders in quarterly installments in the 3rd month of each quarter, so you can expect a small dividend in March, June, September, and December. We've already looked at the companies that make up the top 10 of SCHG, but let's look at the companies that we might also have the benefit of owning if we buy shares. Using the prospectus of SCHG, we can look at the quarter 3 holdings, and here we can review all the different securities housed within SCHG. I'll link this website in the comments below so that you can dig in for yourself to see what other great companies SCHG has to offer. So why would you pick SCHG over other growth-minded ETFs? If we run a pure comparison, we can look at 4 other growth ETFs. And right off the rip, I see high expense ratios for PWB and FTC at 0.56% and 0.60%, respectively. I don't know about you, but I prefer not to take on the increased cost of investing in an ETF for returns less than SCHG. So that leaves ILCG and VUG both with a positive 10-year total return, but SCHG still comes out on top. While I continue to work to build out the core of my portfolio, I needed to take the opportunity for some additional growth. And since I like the idea of that 14% annualized return, I felt like it might be a great opportunity. So what do you think? Is this an ETF that you might consider holding in your portfolio? Leave me a comment below and then go and take a peek at this video next.